All right, let's jump right in. Something really weird has been happening in the markets lately. You've got things that have, absolutely nothing to do with each other. We're talking AI stocks, Bitcoin, and they're all suddenly moving in perfect lockstep. Now, it looks like chaos, but what if it's not? What if there's one single hidden conductor pulling all the strings? Well, in this explainer, we're going to go find it.
And it all starts with a jolt. One minute, everything seems okay, and the next, a huge asset like Bitcoin just hits a wall. The word comes down from the trading desks, and it's blunt. No bids. The buyers have just, poof, vanished. This isn't some gentle little dip. This is a full-on implosion, and it definitely gets everyone's attention.
And it's not just in the crypto world. All of a sudden, volatility, or vol, just starts picking up everywhere. That feeling of relative calm we've been seeing, yeah, that's over. This is the first real clue that the problem is way bigger than just one single asset. You can feel the market's pulse starting to race.
And look, this isn't just random market noise. This is straight-up fear. This quote really nails it. Investors are suddenly scrambling for puts, which are basically insurance policies against a market crash. And as the saying goes, they're not buying this protection because it's a good deal. They're buying it because they're suddenly terrified they're going to need it. Panic is in the air.
So let's just lay out what we're seeing here. This is Section 1, a surge of market fear. We're looking at this wave of anxiety that is crashing over pretty much every corner of the financial world, from speculative stuff like crypto all the way to the bedrock of corporate credit.
And the proof is really everywhere you look. Fear in the tech-heavy NASDAQ is suddenly way higher than in the broader market. Volatility in the bond market, which is just absolutely massive, is surging. We already saw how the demand for that crash protection exploded. And maybe the biggest red flag of all, for the first time in over a decade, it's now seen as riskier to lend to tech companies than to the average corporation. So the takeaway is simple. This fear is very real and it is spreading fast.
Which brings us to Section 2, the psychology of a mania. When you see high-flying tech stocks and Bitcoin crashing at the same time, the easy answer, the most common one, is that it's all just about human behavior. Are we just watching the same speculative bubble pop in a few different places at once?
This is the leading theory, right? It suggests that the same group of investors, all driven by that same potent mix of greed and fear, piled into these trades on the way up, and now they're all stampeding for the exits at the exact same time. It's a simple story, and it makes a lot of sense.
I mean, just take these two, for example. On one side, you have Bitcoin, a totally digital currency. On the other, you have NVIDIA, a company that makes very real physical computer chips for the AI revolution. Fundamentally, they have almost nothing to do with each other. But psychologically, oh yeah, they both became these huge symbols of a futuristic, high-growth mania. So it's not crazy to think they'd be linked in investors' minds.
And we actually have the data to back this idea up. According to a big survey of fund managers, the Magnificent Seven tech stocks are, by a huge margin, the most crowded trade on the planet. And you know what happens when everyone piles onto the same side of the boat? It doesn't take much to tip it over, and it tends to drag down anything and everything that investors lump into that same category.
But this is where our story takes a really interesting turn. Let's head into Section 3, the market's hidden conductor. Because that psychological explanation, it's plausible, for sure, but it might not be the whole story. We're going to go searching for a deeper, more fundamental signal that could be tying all these seemingly random threads together.
I really want you to think about this question. What if the real link between NVIDIA and Bitcoin isn't just some shared mania bouncing around in investors' heads? What if there's a single kind of obscure number buried deep in the plumbing of the global financial system that is actually forcing all of these assets to move together?
And here it is. This is the market's hidden conductor. It's not some flashy tech stock or a crypto whale. It's the yield on Japan's 30-year government bond. Now, I know it's an incredibly niche part of the market, but just look at that move. A jump from 3% to 3.35% might not sound like a lot, but believe me, in the world of government debt, that is a massive tectonic shift.
And the evidence here is it's remarkable. The very moment these Japanese bond yields started to spike, the NASDAQ 100 hit its peak and rolled over. An index of AI stocks has moved in a perfect inverse relationship. Bitcoin's price chart is practically a mirror image of the yield chart. Even the mighty NVIDIA has been marching to the inverse beat of this Japanese drum. This is just way too consistent to be a coincidence.
Okay, so that brings us to the most important question in Section 4. When bond markets scream, why does it matter so much? Why on earth does a little move in a Japanese bond yield send ripples through the entire global market for risky assets? Let's break down how this works.
To get this, you need to know about something called the MOVE Index. You've probably heard of the VIX, right? The stock market's fear gauge? Well, you can think of the MOVE Index as the VIX for the global bond market, a market that is so much larger and more fundamental to the entire financial system than the stock market. When the MOVE Index spikes, it means the very bedrock of finance is shaking.
And that is exactly what's been happening. That spike in Japanese yields was part of a global shock that sent the MOVE Index soaring in one of its biggest jumps, well, basically ever. And if there's one ironclad rule in finance, it is this. Stocks absolutely hate when bond volatility spikes. When the safe part of the market suddenly becomes unstable, it makes investors run for the hills, dumping risky things like tech stocks and crypto.
And this isn't just some short-term market fluke. A highly respected strategist, Albert Edwards, argues that this connection is actually reflecting a deep, structural change in how the world works. He's saying governments are spending so much money that central banks are losing control, and the bond markets are starting to throw a tantrum. This volatility isn't just noise, it's a huge signal that the old rules are changing.
So all of this brings us to our final section. Where do we look next? Now that we've uncovered this hidden conductor, how do we navigate a market that seems to be getting two completely opposite signals at the same time?
Because this, right here, is the core conflict. On one side, you have what you could call the big long. These are huge, rules-based institutional funds, and they are positioned for markets to go up. But on the other side, you have the big fear. Surveys of regular investors are flashing signals of extreme fear. So you have the big money and the popular mood in a total standoff.
And here's one more number that just makes everything even trickier. 3.7%. What is that? That's the current level of cash that investors are holding. And let me tell you, that is critically, dangerously low. The dry powder to buy any dips, it's just about gone.
Now this is the really crucial part. The historical record here is flawless, and frankly, it's terrifying. There have been 20 times since 2002 when cash levels have fallen this low. And in every single one of those 20 times, no exceptions, stocks fell over the next 1 to 3 months. History is siding squarely with the big fear camp on this one.
Which brings us to our final thought-provoking question. If cash reserves are totally tapped out and our hidden conductor, bond market volatility, is screaming a warning, what's the smart move? Sure, you could chase expensive insurance in the VIX, that's the obvious play. But maybe the real hedge is hiding somewhere else. Given all the macro pressures we just uncovered, is it maybe time to look at an ancient store of value like gold instead? That's the tough question this market is forcing every single one of us to ask right now.